Hi, I'm Linda Eedes, and this is an update on the RECM Balanced Fund for the fourth quarter of 2017. So the Balanced Fund had a middling quarter. It was actually slightly down, about 0.5% for the fourth quarter of the year, which I guess, in the context of everything that went on in the fourth quarter with the whole Steinhoff saga and the rest, is probably not such a bad result. As you know, RECM is not a benchmark-oriented investor. We make decisions based on whether things are trading in absolute value territory. In other words, sort of if they're trading substantially below what we believe a business is intrinsically worth, and it doesn't mean anything to us if a business is a significant part of the index. Now, of course, so not having significant exposure to Steinhoff, as many other balanced funds did, was a positive for us during the fourth quarter. So being positioned differently was positive, but if you look at NASPAS and how NASPAS has performed and what a big chunk of the index that is, that was obviously a net negative for us. But I think it does reiterate the point that, things happen that you don't expect. And I think when one has a very sort of big exposure to one particular firm, one can never really be completely sure that nothing can go wrong for that business. So we're quite comfortable that we provide quite a nice bit of diversification for portfolios which do perhaps have slightly more benchmark-oriented portfolios in them already. So as value managers, we sort of just try not to think too much about what's in the index, and we just look for those undervalued opportunities wherever we can find them. And that is within the context of this fund, both globally, up to the sort of 25% maximum that we're allowed per Regulation 28 limits, and of course locally as well. And also sort of within other asset classes, not only just equities. So in terms of sort of impacts on the portfolio and positions that we hold, if you look at the global portion of the portfolio, which is now sort of close to 30% because that has sort of grown over time with sort of above the regulatory limit. But if you actually look at the makeup of that portfolio, some of the things that were positive were stocks that we hold such as Tesco, which continue to sort of reflect what's happening on the ground there, the turnaround story coming through. Berkshire Hathaway, obviously with rising yields being a theme and sort of the central banks sort of hiking rates, businesses like Berkshire Hathaway, which have a lot of financial exposure or insurance exposure in particular, obviously sort of have participated in that in terms of the share prices rallying in expectation of that continuing. And sort of the resource businesses we still hold and commodity producers, sort of the energy producers as well, those also benefited from a continuation of that theme of kind of synchronized global growth. We saw industrial metal prices up again, we saw oil prices up quite strongly during the quarter, and that was positive for some of the stocks we still hold in the portfolio, such as Inpex, BP, Anglo American, BHP Billiton, and such. But of course, when you translate that global portion of the portfolio into South African rands, you have to take into consideration that the rand actually strengthened by 10% during the course of the quarter. So when you convert that back into rands, that would have actually been a negative impact because overall the global portfolio was up a bit. It was about 2.5% up in dollar terms, but translated back into rands, it actually had a drag on the overall portfolio. Looking at the local portion of the portfolio, we do still have quite a strong orientation towards sort of South Africa incorporated stocks, but with the rand having strengthened so considerably, in fact the rand has strengthened by 30% since the start of 2016 after it sold off quite strongly following the whole sort of Nenegate saga, we've started to take a little bit of a closer look at some of the businesses which we like, sort of looking over the long term, which have come under quite a lot of pressure and which are now presenting as potential opportunities. So we introduced, for instance, a very small position in Mediclinic in the portfolio during the fourth quarter. But I think the theme, generally speaking, is still more oriented towards a lot of industrial businesses. We do still have some resources exposure on the local side, very much away from the kind of global multinational businesses which happen to be domiciled or sort of listed in South Africa. And obviously not holding NASPAS is in relative terms did act as a bit of a drag on the portfolio in comparison to what the market did as a whole. In fact, over the course of the last 2 years, NASPAS accounts for half of the return that the market has actually given you. And today, Naspers is obviously close to a quarter of the all-share index, which presents huge concentration risk issues for a benchmark-oriented manager. So I think you can be very comfortable with your RECM portfolio in the sense that it's positioned quite far away from the market. It holds very different holdings to everybody else, which are very much focused on value. So those businesses are trading at low prices relative to what we believe they're worth. And if you actually look at the performance of the portfolio since the cycle started to turn towards value managers, it's actually up sort of more than 30%. And if you compare that to the sector average, so the sort of the sector within which that unit trust sits in the CISA categories, the average has actually been just over 12% for the same time period. So I think all of a sudden, having a value manager as part of your mix of portfolios is actually starting to make a lot more sense for many investors. And we think there's much more to come from a value-oriented portfolio going forward.